What's up, investing legends? Today we welcome Nick Stromwall to the program. Nick's intro to real estate came from the same promise that hooks so many investors: easy, passive income. Then reality hit. Nick realized that traditional passive income wasn't so passive after all. And that aha moment sparked his mission to find a better, more sustainable way to build both wealth and impact. And today, Nick is a part of the investor relations team at Rise48, a multifamily investment firm with a growing portfolio across Phoenix, Dallas, and North Carolina, where he helps investors deploy capital into large-scale real estate opportunities designed to generate strong, risk-adjusted returns. We kick off the episode with Nick's origin story and the pivotal shift from active real estate ownership to true passive investing through syndications. Later on in the episode, we dive into how to evaluate operators, why most investors misunderstand control versus being passive, and the real factors that separate great deals from dangerous ones, especially in today's evolving market. And to wrap up the episode, Nick shares his perspective on the current state of the multifamily sector, where opportunities are emerging, and how investors can position themselves to win big this next cycle. So if you're looking for practical frameworks to build long-term wealth through real estate while understanding how to scale beyond small deals into institutional quality opportunities, this episode delivers perspective from someone who's actively working with operators and investors in real time across multiple markets. So without further ado, everyone, let's welcome to the show, Nick Stromwall.
Welcome to the Investing Secrets Podcast.
Nick, welcome to the vault.
Thanks for having me on. Yeah, pumped to be here and to get to know you more and hopefully share some wisdom bombs with your audience.
Yeah, man. No, the second that we had our first phone call, I was like, Nick's got to be on the show, man. I just felt like you have a really interesting background, and obviously now you work with Rise48, multifamily syndicator, predominantly in Phoenix, yeah, or in the Sunbelt, or in Phoenix, or where are we?
30 assets in Phoenix, 20 assets in Dallas, and 10 and growing in North Carolina.
Mm-hmm. Yeah, so you've got a lot of properties in and around kind of like the Sunbelt area, and I'm just curious because you didn't start with Rise48. You had some other things going on, and I'm wondering like what got you to this point, right? Like kind of walk us through the journey.
Yeah, like a lot of people, wanted to earn some extra cash. My wife and I were mentoring college students in Minneapolis, and got to get really close to them. They'd go on these summer trips, and they'd send us letters to help support them. And we were missionaries at the time, doing college and ministry. So we were looking for a way to be generous. I found myself driving around downtown Minneapolis with my pickup truck, picking up those electric scooters at night, eventually working my way up to get 20 scooters, $100 a night. But I found myself really missing time with my family and wanted truly passive income. So a deep dive down the hole of Bigger Pockets and a bunch of real estate books led me to purchase my first duplex about 16 years ago. And it was a great adventure of learning how to negotiate and work with a business partner. It made us $600 a month for my family, and $600 a month for my business partner. And that was really powerful, knowing that this was something that was growing in value, but also helping us, be more generous and also meet the needs of our family. So we did a few more of those, and Airbnb. We started having kids, and then we were like, this is too much to manage, running around town, fixing holes and finding tenants and all the things you have to do, actively managing. So we wanted to go truly passive, and that's when we learned about commercial real estate syndications. My grandma gave us some early inheritance, and we kind of pushed it all in, investing in learning how to underwrite deals, joined a community, got a coach, and figured out you can either get good at finding the deal or you can get good at raising the capital. I tried my hand at both, but really fell in love with helping people multiply their money. So more importantly, they can multiply their impact.
Love that, man. You've had some practice with that, haven't you? That was maybe the most succinct overview that I've heard somebody give on a podcast in a very long time. Well, I love that, man. And I completely agree that in this business, the more you get into it, because from the outside looking in, it seems very simple, right? You buy real estate and you make money. But people don't understand how complicated this business really is. And how specialized you can really become. And the deeper you get into it, the more you realize, wow, like, yeah, I can't like source a bunch of great deals and raise a bunch of money. Well, you could, but like you wouldn't really get anywhere, and you can build a team, right? Eventually, and like build a team to kind of help facilitate that whole thing, which is what you do primarily now at Rise48, where you're part of the investor relations group. And then they have this massive kind of like team underneath them. But where did that click for you? Like, when was it that you said, like, man, I think that I should just go all in on raising money for these deals?
Well, it's funny. I have family members who are financial advisors, so was taught at an early age compounding interest. Feed the pig, and started a Roth IRA after I started working at Culver's. And a little bit every paycheck can produce a lot over time, and it's only kind of giving you one of the wins. If you think about baseball, you can hit a single, a double, or a triple. In investing, what it felt like was investing in the stock market was just hitting singles. Singles are great. You need those for any successful team. But if you can get not only that single of cash flow, consistent distribution every month, but if you can also get the second win, appreciation, the upside of real estate tends to go up in value in a 5 or 10 year cycle. And then this third component, which I didn't really understand, but I think it's maybe the secret sauce in real estate investing, and that's the tax savings. So why hit singles when you can hit triples? And I started to experience that owning that duplex and owning multiple properties in an Airbnb. We bought our first duplex for $140,000 and sold it 10 years later for $350,000. And in a 10-year period, we were getting consistent cash flow. We were getting appreciation. We were getting tax depreciation. So we were saving on taxes. We did a couple cash out refinances, and we sold for a profit. And that was just a microcosm of my personal portfolio. But what they don't tell you about managing properties is it's a lot of time. It's a second, third, fourth, fifth job with cutting the grass, fixing stuff when it breaks, painting when tenants turn over, dealing with problem tenants, the quintessential toilet breaks in the middle of the night and they call you and you have to go fix it. That happened. So all of those things you have to actively manage. And yes, you can hire property managers, but that takes a cut into your profit, and no one wants to, necessarily take a cut into the profit. So I just found, I want to be a present husband and father. I'm a proud husband of almost 18 years and a proud dad of 4 kids. That's like my best part of who I am is loving on my family, but I also want to be a faithful employee and a faithful business owner. And if you own property, you also have to be a faithful landlord. And I just found it challenging to do all of those at the same time. So what I thought was passive income, owning that duplex, actually turned into a lot of active management and a lot of hours. So syndications, where you commit your capital, you pool your capital together with other investors and buy a bigger property, you can afford to hire a property manager. Or at Rise48, we have our own team of property management and construction workers that do all the work. But you have to start small. And I started with an up-down duplex of, 3 bedrooms and 1 bath up and 3 bedrooms and 1 bath down. But that produced a few more properties and then an Airbnb, and then learning, man, commercial real estate, there's actually more upside, more value. Residential real estate, your value is purely determined by what your neighbor can sell for, comparable sold. Whereas commercial real estate, it's all about the net operating income, the difference between your income minus your expenses. So if you can find ways to create more income, and you can do that through renovating units or figuring out ways to bundle services or installing carports or adding washers and dryers, whatever it may be. And, bring in operational efficiencies, sometimes pretty simple stuff like low flow shower heads and energy efficient appliances. if you can find ways to decrease expenses, you can make it more profitable. And if you own a 100-unit apartment building and you put in a washer and dryer and you drop, $1,200 on that, you can increase the rents 50, 75, sometimes $100. You make it up in a year, and now you've just forced $500,000, $600,000, $700,000 of value that is then distributed, amongst all of your investors. So I kind of just started thinking bigger because at a certain point in my life, time became one of my most valuable assets, and I wanted to be present with my wife and my kids. So that was a big change for me. But man, investing in yourself is so hard because you want to be a good steward too. And this program wasn't cheap. It was $20,000 to join this program, and it was a lot of money for us. And yet, when you invest in yourself with money and with time, that produces an exponential impact. So, 50% of a deal is better than no deal at all. I probably wouldn't have bought the duplex unless I had a business partner, but that started the cascade of these other events. And, now I'm 17 projects into these different syndications across multiple asset classes, and Oak and Vine Capital, kind of the foundation of my capital raising business, was formed.
You touched on something earlier that I want to revisit.
Okay.
In a past life, and I think you know this, Nick, I was a realtor, and I cut my teeth in real estate first as a residential real estate agent, and worked with a lot of investors in that time. And frankly, once I dove into the world of commercial real estate, many years later, and really started understanding the world of syndications, funds, etc., I was shocked. I was shocked at the discrepancy at the returns that you're able to generate from a commercial real estate standpoint versus residential real estate. People, there's a lot of gurus online that tell people, the BRRRR strategy and buy all these residential properties, and don't get me wrong, better than your money sitting in the stock market for sure. But the beauty of the stock market is that it truly is a passive investment. You put it in there and you let it ride. I mean, you're not sitting in those board meetings, right? You're not hammering those nails or making those iPhones or whatever. The difference is, and you touched on it, is that the gurus online in the residential world sell residential investments as passive income, where unless you hire a property management team, right, you are effectively buying yourself a job. And even if you have a property manager, you're still buying yourself a job because you still have to make decisions. If you're not property managing, you're asset managing. And if you're asset managing, that requires a level of aptitude, and it requires it requires diligence, and it requires time and attention and all those things that people really don't have because they're focused on making money in their real job. So the syndication part, though, is like the best of both worlds. It's like, hey, I get the passive nature of the public markets with the upside of real estate investing and everything that it provides you. By the way, there's more upside. Now, here's my question for you, because, I'm just chatting here. Why? So I've had many, many investors who I have from the mountaintop, just screaming, yelling, you got to do this real estate syndication. You got to invest in these funds and these syndications. And the biggest argument that I hear against investing in syndications and funds is that, well, I would love to do that, but then I'm giving away control. I'd rather control the property. I'd rather control everything. So number one, why do you think that investors feel this way? And in your position, what would your advice be to somebody who is of that opinion?
Yeah, really good question. I mean, I think everyone's foundation when you're in the capital raising space should be, number one, preserve capital for your investors. No one wants to lose money, right? And if you're in control, you feel a sense of, well, that's in the bank, or it's earning interest, or it's in the stock market. So control is not a bad thing. I think at the end of the day, though, you give up control to gain being truly passive, right? I invested all that capital in these duplexes in this Airbnb, but I'm in control. So when there's a problem at my Airbnb, I get the phone call. I got to deal with it. Versus when you invest capital in a syndication, you just get that monthly check, and it's coming, every month. It's mailbox money, as they say. You don't have to worry about the business plan because you've done the research and the due diligence on your team, on your jockey, on the operator. And who you choose to be your operator really matters. When I first got started, I generated a list of 40 or 50 different companies that would send me deals and have me check out these different opportunities all over the US. And I would go out to a meal with each of those operators to just get to know them. And 2-minute test, I saw how they treated the waiter or the waitress, and I knew right away if I wanted to do business with them. Of course, I did my full due diligence on each operator before partnering with them. But when you have an operator that is after not only giving you a great return, typically in this space you're aiming for roughly a 2x return in 3 to 5 years. That's kind of the bare minimum. But you're finding deals that can regularly give those types of returns. I tell my investors, there's no guarantee. You could lose it all, right? Worst case scenario in multifamily is all of your tenants lose their jobs and they can't find new work. Then that would be kind of worst case scenario. But we're investing in areas where there's tons of companies moving to these areas to produce jobs. And there's lots of people moving to these areas because it's a great place to live and raise a family. So if you can find a good operator that not only wants to preserve your capital, but also wants to serve the tenants, like at Rise48, we've got community managers at all of our buildings, and their main job is serve the tenants. So I see them walking around high-fiving the grandmas and low-fiving the kids and having these monthly events put on, fixing problems right away when they come up. But if you do that, then all the tenants tell their friends about it, and you actually create a community, and then people don't want to leave, and then your vacancy problems go away, and you have this community built of people that enjoy living around each other, right? So yes, you lose liquidity. That's kind of like the major downside to syndications is these are illiquid investments. You don't know exactly when you're going to get your capital back. But if you choose the right operator and you look at the track record of past deals and performance, you can, multiply your money a lot faster. I tend to tell my investors in the stock market, on average, you're doubling every 7 to 10 years. That's kind of like get your 100K and get your 100K back plus 100K profit every 7 to 10 years. Obviously, the last few years, the market have been pretty awesome, but it cycles, right? On average. In multifamily or in a lot of real estate syndications, you can, double that and double your money in 3 to 5 years pretty regularly. So that's what I like to communicate, because you're not only getting that consistent cash flow, you're also getting the upside of appreciation and then some pretty substantial tax benefits. So I guess how I would coach someone through that is every investment, carries risk. You could invest in a stock and they pick a bad spokesperson and the stock tanks, right? That can happen. When you invest in an actual physical asset, it's got a parcel ID. It's worth something. And if you can invest in a team that is a good steward, they take what you have and make it better and invest in the people and care about you as an investor, then I think you pick a good team.
So, well, there's a lot to unpack there, and I think the overarching message that I'm hearing, Nick, is pick a good team, right? Is which easier said than done,
right?
Because I believe what we're seeing right now, or what we've seen in maybe like the last 5 years, is the best operators are not necessarily the best marketers.
Right.
And the best marketers are usually shit operators, and so that causes a lot of problems.
Yeah.
in the marketplace. And of course, I think a lot of those bad actors have started to they've gotten weeded. They're getting weeded out. Except, right? So, but here's the problem, right? And we can speak to this a little bit. The biggest issue that I see is that we've got like 3 tiers, right?
Yeah.
We've got good marketers, or we got several categories, right? We've got good marketers, shit operators, good marketers, good operators. I think I'd put Rise48 in that category because you guys do a good job, right? Marketing yourselves, but also clearly competent operators. Then you've got the opposite, which is, horrible marketers, good operators.
Yep.
By the way, that's a big segment of the market.
I think you're
it's
right.
a big segment of the market.
Yep.
And then there's bad marketer, bad operator. Those guys don't last at all. The issue is that the good marketers, shit operators are now subdivided into 2. Those that are smart enough to start their own private credit funds to save their deals, right? So now it's like, hey, we're going to start a preferred equity fund to save the deals that we have that are upside down. So how much do you know about that? Right.
Yeah,
I'm not asking you to talk bad about your competition. I'm just saying, like, how much do you know about that, and how do you spot that as the consumer? Like, how can the consumer kind of like zero down and figure out, like, hey, like this is a bad apple, and bad apple investment, bad apple organization, and et cetera.
I think the best thing to do is ask your friends who are in the space, where are you guys investing? Which operators do you know of that are giving you, consistent quality returns while also developing communities? I think, for Rise48, we've really grown and scaled because we have a lot of repeat investors and a lot of investors telling their friends. I probably jump on, a handful of phone calls every week because someone referred us to someone else. And that just goes to show there's great websites out there that give reviews. And I'm sure you could probably name or list a few of those out there. So reviews and then current investors really make a big difference. And every niche of asset class has had its ups and downs. And multifamily really had a challenging time in 21 and 22. We had 11 full cycle deals and they were slam dunk deals, a 2.1 equity multiple in 18 months or less, 70% IRR. So they were slam dunk deals. We purchased 20 deals when the interest rates went from 4 to 8 in markets where we were having negative organic rent growth. And we were able to weather that storm because our founders, kicked in multiple millions of dollars at 0% interest. And these guys aren't, rich family. They're just kind of self-made, but they cared so much about their investors and companies, they're willing to do that. We did do a preferred equity capital call structure on some of those 21 and 22 deals, but we did it in such a way where it was optional and people won if they participated, and I think when you make it optional and you give people an upside by moving their common equity position up to a preferred position, I think that goes to show, hey, if you help, this deal continue to give it some more life, we think we can continue to execute on the operational side to weather the storm. And we're still weathering that storm. And every time the interest rate drops, that gives us a little bit more relief. But I think we're going to make it out of those deals fine, especially for the investors who were able to participate. We've had 35 deals since that challenging dynamic summer of 22 that are cash flow positive. As a company, we've never missed a debt payment. We've never lost investor capital. So every operator probably has their story, right? And that was a challenging time for Rise48, and we're open about that. And we did weekly videos, and we communicated, probably over communicated in a lot of ways. But I think it's important when you do go through trials. One of our properties had a fire. I think 12 units went down. We just communicate about that. That's going to delay what we projected for an exit by a little bit, but who could have forecasted a fire in a building, right? So you have to be nimble because you can't say exactly on this date is when you get to pull your money out. We typically say it's, somewhere between 2 and 5 years. And it could be a little bit longer and it could be a little less. We don't exactly know what's going to happen with the new Fed chair, with what's going on in the economy, the next president. All those things really, really matter. But we're choosing areas where we're forecasting, job growth. We're forecasting organic rent growth, meaning there's more people moving there and not enough places to stay, which means the prices generally go up. There's a lot of places that we're battling negative organic rent growth, and you can force rent growth through the value add strategy. So we kept our foot on the gas as a company to continue to renovate units to force NOI. So I think at the end of the day, it just comes down to the operator. Do they care about you as an investor, and do they care about the people in their building? And if both of those check yes, then they're probably a good operator.
Well, first of all, I appreciate your honesty on that, and I think that's a big deal because frankly, I think the type of, there's really two types of groups that are kind of that are weathering the storm right now, right? It's the ones that are open about it and they're communicating. And by the way, that's the sign of a good organization, because communication is actually the number one reason why most investors don't go back to their syndicate, the group they invest into, right? It's like most investors, their number one complaint is lack of communication. So if you've got the communication dialed in, you're halfway there. Because truthfully, I think coming full circle to the I want to be in control. I actually don't think that that's what people want. I think they just I think that they want to know what's happening at all times. Right?
Yeah.
Because, for example, right? Have you ever seen I've been thinking about this a lot because recently there've been a couple people who passed away online, like kind of fringe celebrities, but they don't list the cause of death. So-and-so passed away. And in the comments, it's like, man, like what did they die from? What did they die from? Everyone wants to know.
Right.
That knowledge changes nothing. Right. But I think from a human psychology's perspective, people need to know, why did this person pass away? Because, well, is it it's just a human psychology thing to it's you're grappling with your own mortality. And then I think in the same light, when something goes wrong or when something goes good, with your investment, you just want to know. And with the stock market, it's right there. The feedback is instant.
Yep.
Right. But with syndications and other types of investments, you can go weeks, months, years without hearing. It's like, hey, I'd still my dad's friend. I was chatting with him the other day, and we all just kind of got together, and my dad's buddy was talking about the syndication that he was a part of. And he was like, yeah, they sold it a year and a half ago. He's like, yeah, I still haven't gotten my check. I'm like, man, so Nick, I'm just like, come on. And in my head, I'm like, man, this is just a horribly run operation. So there's so many varying degrees of competency. And I think a core tenet of competency is communication. Right. And so I think that's great. And yeah, another note that I had here to comment on is, do you really want to be the one who's in control when 12 units go up in flames?
Right.
Everyone says, I want to be in control. It's like, are you sure?
Well, everyone has a different level of sophistication too. Well, some of our investors, are operators themselves, and they've, run the construction project on, huge buildings and they've done huge undertakings, and they know that if they are in control, they have the control rights that they can execute the way that they want. But people who we typically are attracting, they have capital, they don't have time to go out and find a deal, manage the deal, run the deal. So they would rather find that trusted partner that has the experience and the team, the boots on the ground that has, experience and experienced success in the past, commit their capital, be a limited partner, but get the benefits of truly passive income where it comes every month, right? And I think that's the power, because in in this field, you make most of your money when the deal goes full cycle. And operators, they get paid after you get your preferred return. The way we structure it is you get your preferred return, you get your full return of capital, and then you get a bulk of the profit. And we don't get anything really until the end. So we're motivated to do a good job because we want to get paid, and we want you to be a repeat customer. We want to double your money so that when our next deal comes, you're looking and saying, Nick, Danny, that was awesome. What's your next deal? And now you've got twice the firepower to go after bigger and more deals.
I love that. I couldn't agree more. And yeah, I mean, properly structured syndication is one where everyone kind of comes out feeling like they've won, right? Or the investor, doesn't feel like they've gotten the short end of the stick. And switching gears a little bit here, because I want to touch on this. We've talked about it a little bit already. The turmoil or like the turbulence that the multifamily sector has experienced over the last couple of years.
Yeah.
Where do we see this going, Nick? Because you guys are boots on the ground. You're seeing this every day. Like, what's happening right now with the debt markets? What's happening right now? With occupancy levels and man, I've seen so many multifamily deals now where the concessions are out of control right now. So, what's going on right now, and kind of walk us through the lay of the land.
Yeah, the market's definitely shifting. I mean, it had been pretty normal for Class A multifamily to give 2 or 3 free months of rent, which, if you can get that much free rent, you've got Class B kind of housing, 1980s, 1990s, early 2000s. You have those tenants trading up to Class A because they can afford that. And then you have Class C tenants trading up to Class B. But that's really starting to go down. We're not really seeing maybe 1 month free, but even that's kind of going away. Maybe it's a free big screen TV upon move-in. So a lot of our markets, the concessions are really wearing off.
Wait, seriously?
Sometimes, yeah, free big screen TV if you move in, right?
That's cool.
Whatever gets people in the door, and sometimes that's what it takes. But we're seeing concessions kind of wearing off in Phoenix, in Dallas, and then in North Carolina. The projections based on CoStar data is, this year where there'll be, positive organic rent growth, meaning you don't have concessions anymore. It's just, you want a good place to live, you gotta pay your first month rent up front, right? So I think that is producing more optimism in the market. Rates continue to experience some relief, and that is projected to continue into this year. We've got a lot of units in our portfolio that we're going to be looking to start to look at a sell probably next year. So that's exciting as a company, thinking about weathering that challenging storm in 21 and 22, and then getting to the point of being able to sell our product. So, for us as a firm, we're all about the velocity of money. If we can give our investor, roughly a 1.6 equity multiple in 2 or 3 years, we'll look to sell the deal because we're all about, the velocity of new deals coming out and allowing our investors to 1031 out of a deal into the next deal if they want to. With bonus depreciation being at 100% right now, a lot of investors aren't even looking at a 1031. They're just making sure whatever capital gains exposure they have for that year, that they have enough offset for new investments that they make to give enough bonus depreciation to offset capital gains. So if you can invest with a firm that has, steady, ongoing deal flow, you're going to, align yourself with the right team. It's March Madness right now. Everyone's, making their picks, but if you can, if you can make the right pick with the right team, you're going to be okay.
I literally spent like 5 minutes this morning. I got a notification, like right when it was the first thing, like 6 a.m. when I woke up, and I was like,
better do it.
Like
auto pick.
And then it says like, don't forget to make your picks. And I was like, okay, so like literally it took me like 5 minutes, like click. We'll see how that goes. Probably like. I'll probably get like 10% percentile. Oh man. Cool. Well, Nick, we are, coming up on time here. Just a couple last minute questions here. Before we get into that though, obviously if the folks at home who are listening to this want to get in touch with you, learn more about Rise48, where can they find you? And all of everything that you list right now will be in the show notes and in the description below.
Yeah, just connect with me on LinkedIn, Nick Stromwall, Nick at Rise48Equity.com. Would love to see if there's an opportunity for us to serve you.
Love it. So looking into like if we were to kind of like subdivide the different classes, right? So I would assume Rise48 predominantly Class A multifamily, correct?
Actually, a lot of ours are we're buying kind of B plus assets and making them into Class A minus is what we typically say. So we like to buy in B and A areas and generally going for that workforce housing. Some of our recent acquisitions have been newer, where even the median income in the areas are up over $100,000. So I think as we continue to grow as a firm, we might get into some Class A, but we find the value add of space to be where we can give our investors the best returns. So that's where we've had a lot of success. Investing somewhere between $10,000 and $20,000 per unit. Some of our recent acquisitions have been a little bit more on the light value add scope. Closer to that $5,000 per unit renovation, where the units are new enough where we don't have to do a full renovation to be able to force the value creation. We can force value creation just with the scale of what we're doing. So, for example, one of our latest deals, the pro forma was only increasing rent by about $90 per unit. And we were able to come up with $50 of that rent increase just through doing a bulk contract with some of the bundled services that the tenants were already paying for. You're thinking about internet and streaming TV and even implementing valet trash, things the tenants were already paying for. But because of the scale of, controlling over 50 assets now, we're able to leverage that, get a bulk contract and, earn about $50 per tenant that are participating, which meant we only needed to go about $40 per unit to hit our pro forma of roughly that 2x return. So we're getting creative. We're finding great deals. We've got awesome relationships with brokers in all 3 of our markets, and they often call Rise when they need to close. We have 100% close rate, so we've become a trusted partner with a lot of our brokers.
The properties that I've seen, and the reason I assume Class A, I think I see a lot of product after you've done the value add component, right? So, and it makes sense to me. The business plan, the business strategy, makes sense to me. My question is, right, so if we're if we're repositioning these assets from Class B to Class, or you said B plus to A minus, right? Where do you see that business plan taking off over the next 5 years? Because right now, I do see like a lack of, there hasn't been a ton of development these last couple of years where the debt markets are at. So how does that business plan kind of play into the lay of the land and like the overall lay of the land in terms of like competition, right? And I'm assuming that there's like a reason why you've chosen to adopt this business plan.
Yeah, I think if you can find areas where you're going to capture that organic rent growth, back in 2021, you can make money just by slapping new paint on the wall, right? Because the value of multifamily was just climbing. Now you need to force the growth by offering a product that's better than what the market can offer. If you can offer a product that's nicer than your neighbors at about the same price, people are going to go to the nicer place. And because we've kind of developed this brand of, really nice exterior and a nice clubhouse and nice amenities, whether it's the pool or the workout facility, people think of Rise apartments as, oh, that's a really nice place to live, even though it's still kind of in that affordable range for people. So perception and marketing, to your point about how marketing is important, like we invest there. And I think, investing in nice signage, for example, matters, right? Because you want to be proud of the place that you live in, whether you're there by yourself or with your family. So we think this kind of value add space is going to continue to be a place where we can deliver, great returns for our investors, and also be a part of, building communities. We're even exploring partnerships with nonprofits and churches to tap into some of the services that they provide to help serve some of our tenant base. So there's kind of some exciting kind of pilot programs going on right now. So I'm really excited to see how those shape up.
That's cool, man. Well, I'm excited to see what you guys come up with, and look forward to being on the sidelines, witnessing your growth. But before I let you go, Nick, we can't let you leave the vault without sharing with the audience one final golden investing secret. Take it away.
Yeah. I think there's a way for people to win at work, win at home, and win in community. I think a lot of people are maybe focused in one of those areas. Maybe they're crushing it at work, but life at home or with their friends isn't good, or they really don't know their neighbors. And I think balance is a really hard thing, and life is seasons, right? But I think there is a way where you can continue to grow as a leader in the workplace. You can continue to grow in the leader, in your home life, and you can also serve people. So I talk a lot about that online, and would love to connect with you to share more about that.
Nick, love it, man. Thank you so much for stopping by, and look forward to seeing all your continued success, man.
Cool. Thanks, Danny. This has been a good episode. Appreciate you.